This is a promotional podcast for EIS Platforms Limited Trading as Growth Invest. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high risk investments and you are unlikely to be protected if something goes wrong. Don't invest unless you are prepared to lose all your money. Hello and welcome to the Alternative Thinking Podcast with me, Melissa Griffiths and Steve Dobson. This is the podcast that takes a deeper dive into the alternatives, marketplace and exploring topical issues. Today's guest is Simon French. Hello.
Hi Melissa, hi Steve.
Now Simon, can you do a little bit of a bio for us just so we can get a feel of who you are?
Yeah, I can. Career split into two halves really. One decade in the public sector, in the civil service. Latterly in the Cabinet Office, and then the last decade in UK stockbroking, so at Panmure Gordon, where I'm Chief Economist and Head of Research.
Perfect. And also, you write for The Times?
I do, yes. So the other sort of string to my bow, perhaps, is the media stuff I do. So fortnightly column in the Times newspaper, which I've done for about 8 years, and regular slot on BBC Today programme, Wake Up to Money. So, look, I don't think the UK is brilliantly served by economic commentary, so if I can do my bit to correct for that feels like something of a public service.
So doing a podcast with us today, water off a duck's back, basically.
We'll see, but yeah, I'm certainly hoping so.
Well, we're delighted to have you. So I think just to start with, can you give us your feeling? It's been a turbulent few years.
Yep.
Obviously, we all know we've had the pandemic, the war in Ukraine, cost of living crisis. Can you give us a sort of backdrop, sort of
state of the nation?
Yes, where we are.
Of course. So, look, the UK economy is bigger than it was pre-pandemic, but we are 4 years on, and that's not a great achievement. It's been sluggish for the last couple of years, and therefore you'd have to say, if you look at normally an economy of the UK scale grows at 1.5% to 2% per year, that's 3 or 4 years of lost growth, honestly. Now, there are mitigating circumstances, and you mentioned some of them. Certainly the spike in energy prices that, it preceded the Ukraine war, but then was amplified by the Ukraine war. Then also the pain that was put through supply chains as a result of COVID restrictions. Those are some pretty big shocks for an economy to deal with. Yeah. But I think for an investor base, looking quite jealously and often overexposed to the US economy, looking at economies, perhaps more European economies, the UK economy that's growing slower, there is a battle for assets and investment location. And at the moment, the US is winning because it's winning the growth race. Yeah.
Actually, Brexit's not something that we generally want to bring up, but I know there has been talk previously that Brexit whatever meant that we had to address capital markets in the UK, didn't we? Because naturally we were seen as the place to go after the US.
Yep.
But now there's a lot more frictions that we need to get, and there's a sort of a lot of bodies trying to change and get implementations into the UK markets to really sort of try and improve things, aren't they?
That's right. Well, look, Brexit was not the initial catalyst for the decline in UK capital markets activity, but it accelerated it, it amplified it.
Well, and actually made people have to look at it, didn't
Correct.
They? Yeah.
So let's not get into a sort of perhaps something of a sort of false quantification of the impact of Brexit either at economic level or capital markets level, but let's take a more positive approach on some of the reforms that are now coming through, and where's the government, or the current government at time of recording, are badging these the Edinburgh reforms, but also its Mansion House reforms of UK capital markets to make them more competitive. And that follows a suite of reviews by Ron Khalifa, Jonathan Hill, Mark Austin, Rachel Kent. I mean, if inflows were based on the number of reviews, we'd be doing fine. But it provides, if you like, an intellectual basis for the types of reforms to the research market, to the listings market, to the allocation of capital through Solvency II reforms that bring a bit more activity back into UK capital markets, but also something I've written a lot. You mentioned my Times column, wrote one last month about bringing risk back into the economy. Risk has got itself a dirty word. It's seen in a negative context. Risk isn't a negative word. Risk is something that is part of innovating. It's part of growing. It's part of creating new ways of using factors of production to generate wealth, generate livelihoods, generate employment. So I think we're starting to get a more better balanced conversation about risk. But I think with all these reviews, all these reforms, there's more to do in that space.
Well, I mean, I think that naturally is going to lead on to where I think you're going to move to, Steve. But risk is huge for the platform tax-efficient investments, because obviously they are venture capitalist startups where there is a huge amount of risk in the business initially.
I guess if you look at our client base, who are they? It's wealth managers, and they're advising their clients to invest in risk taking is part of that investment process. So they use our platform for alternative investments, predominantly tax efficient. And most of those tax efficient, what are they invested into? As Mel said, it's into venture capital, into startup companies. For a lot of the factors you've already mentioned in the state of the nation, I guess.
Yes.
High interest rates, high inflation. There's been enough reasons for people not to invest. And we saw a lower level of investment last tax year. But also one of the other factors that really stands out is the lack of exits.
Yes.
And talking about capital markets and the movement in capital markets, what's going on there and why is the M&A activity level so low at the moment?
Yes, a couple of things on exits. First of all, one of the exit routes, and by no means all of the exit routes, but one of the exit routes, IPOs, initial public offerings, worldwide, and this is not specific to the UK, there was a big surge in IPOs in 2021. In the UK, there were more than 130 on the London Stock Exchange. But there were huge numbers of pan-Euro, pan the US. That cohort of new companies to public markets then performed very poorly in 2022 and 2023 as interest rates went up. The cost of capital got higher, and portfolio managers who had bought those initial public offerings would probably, it's the first thing they would sell. It was the first thing they'd sell because it was probably the company they were least attached to, had less of a track record, but also because they're growth companies in large form, they're more impacted by a higher cost of capital. So that's one of the reasons why exits have been at a slower pace. But you're also right that private equity is not immune to all of this. There's, of course, a runway, isn't there, for a capital raised at a lower nominal interest rate the end of 2021. But actually, anybody raising new money, when the risk-free rate globally is between 4 to 6%, and then you add in a risk premium on that, you're looking at a cost of capital approaching double digits. That's a very, very different funding environment. And to some extent, what we're seeing is, and I'd say, a healthy adjustment in valuations to a different cost of capital environment. And while for a period of time, there were a number of business owners who went, oh, well, hang on, well, interest rates will go back to zero in short form, therefore we just sit tight with those extended valuations. I think we're now seeing a recognition that it is a different sustainable cost of capital environment, and valuations are adjusting accordingly. Yep. And the good news is when that happens, these exits, the M&A activity, and by extension the IPO activity starts to increase. And we are seeing tentative signs of that.
Mm-hmm. Mel, do you want to go on to that IPO piece? I think that's quite important, isn't it?
Yeah, where I was sort of going to move on to was AIM as well.
Yes.
Because again, in the tax efficient space, we have the AIM IHT portfolios, and we also have some AIM EIS. And VCTs are also exposed to AIM. It's the alternative investment marketplace. It's declined massively in terms of listings.
Yep.
And, the number of companies, I think, gone from over 1,000, I think it was back in 2015, to something like 700 now.
Yeah.
And it used to be a very buoyant marketplace for new, innovative companies to want to go and list on. It's just not like that at the moment, is it?
Three things going on. These things are never single issue events, certainly trends of that scale, and your numbers are spot on there in terms of the decline of number of AIM-listed companies. Small cap globally has struggled in recent years because of a move towards passive index-based investment, of which flows are navigating up the market capitalization scale, up the liquidity spectrum, particularly liquidity in the UK post Neil Woodford and the Woodford scandal. Yes. You had a big impact on risk appetite at that end of the market. Secondly, there has been some political uncertainty around IHT, EIS-VCT, potential change of government. Now, while Rachel Reeves give her credit and the Labour Party have haven't really suggested any big changes. There is a suspicion that some of the think tanks very close to the Labour administration, Resolution Foundation being one, and of course their head has recently announced himself as a candidate, a Labour MP candidate, has suggested that tax relief is too focused on a small group of very wealthy individuals and needs to be, if you like, levelled up or levelled down or indeed levelled across, depending on which your descriptor you want. And that has made people nervous that perhaps AIM, where the IHT advantages are material for quite a few names on that index, if they are up to there's some political uncertainty around that. That has suggested to investors maybe it's sensible to take some money off the table. And then third, of course, it's similar to the IPO market, is that the cost of capital environment for growth companies, and AIM is traditionally a home of more growthy companies, if they don't have the backstop of a strong dividend paying record and can compete with the yields now available in fixed income markets, investors are just making a decision in terms of their allocation where they're looking for the potential total return not as attractive as they can now get in fixed income markets.
So I think you've covered off quite a bit of this in what you've just said there, but there's a dislocate, it seems, at the moment. If we look at kind of blue chip equity markets versus the small cap, blue chips across the globe are hitting all-time highs.
Yep.
Even FTSE, that's been trundling along for a long time, is now hitting all-time highs. Yep. AIM, we saw a huge response on the back of, we had the big sell-off in all markets on COVID.
Yep.
AIM really responded superbly well on the back of that, hitting highs or much higher than the pre-pandemic levels, but then sold off. So what's your take? I know you've covered a lot of it there, but is it the sectors that are predominantly in AIM, or what's the kind of other moving factors for that?
Well, there's one that I think is very relevant, which I didn't mention in my previous answer, which is Mansion House reforms. So the Mansion House Compact, which was announced about just under 12 months ago from the Chancellor Jeremy Hunt, he got 9 DC pension funds to sign up to allocating 5% of their assets to unlisted equity. But that includes in the definition AIM and Aquis listed equity. And there was quite a lot of hope. And indeed, I had exchanges with the Treasury at the time that this was a design feature, that there was a hope that there's some of that flow from those institutional managers would find its way into AIM, defined as it is as unlisted equity, at least in the definition of the Treasury. That hasn't happened. There's been some conversations around those big asset managers setting up AIM funds to as part of that allocation process, but it's been more conversation than a movement of assets. Right. And as a result of perhaps hope then giving way to the reality, I think that has also meant that some of the enthusiasm that had been beginning to emerge had then dissipated. And of course, this is a very pro-cyclical environment in terms of asset pricing, which means can be very pro-cyclical on the way up, as we can see with NVIDIA and the Magnificent Seven and mega cap. But it can also be pro-cyclical on the way down, and therefore selling pressure, bequeathing selling pressure is something of it. Some people call it the doom loop, something of what is happening in UK small cap at the moment.
Which actually leads us nicely onto the idea of pension fund money.
Yes.
And I know it's a favourite topic of yours. And again,
I know, I'm very boring.
No, but again, we have, different governments and different legislations coming in all the time, ideas with the British ISA was the last thing coming out of the budget.
Yes.
LTAFs, interesting again. What's thoughts on all of this?
So I think too many people dance around the handbags on this one, and I'm not going to do that because it doesn't serve the viewer, the listener, well to not address the issue head on, which is a lack of home bias in pension fund allocation to its domestic UK market. We have done everything that the business school textbooks tell you to do, which is to remove home bias and allocate. Most pension funds now, most wealth managers do it on a global benchmarking level, global mandate, where the UK is about 4% of allocation. bear in mind that no other major economy has done that. It's a little bit analogous to unilateral nuclear disarmament. It sounds great until you realise everyone else has got nukes and you haven't. Yeah. Or unilateral free trade. You've lowered all your tariffs, but no one else has. It's the problem of looking at other economies, and I look extensively at the Australian experience, the Canadian experience, some of the European economies that have retained a home bias. And why have they done it? They've not done it because they're ignoring the business school, if you like, first order recommendation, which is you remove home bias. But they've recognised that a strong natural buyer of your capital makes for a lower cost of capital in your domestic economy. It has an economic growth blowback. So to go right back to the start of this interview, one of the reasons why UK growth over a prolonged period has underwhelmed versus international comparisons is we have underinvested. We've underinvested in our domestic economy. Now, that's entirely rational for the individual saver to buy a bit more Nvidia, buy a bit more Meta, buy a bit more Amazon. But ultimately, what are you doing economically for the wider economy? You're lowering the cost of capital for big US tech, and UK tech, which wants to come to public markets, wants to raise capital, wants to grow, wants to compete, is starved of that capital. So as I say, I don't want to, some people use weasel words to try, because they're scared of saying home bias because it gets people all anxious. I'll take it head on. And I recognise the conflict of interest that I work at a UK investment bank. But as an economist who works at a UK investment bank, I do recognise that the allocation decision of savers is not just about their returns, but it's about the cost of capital environment for your domestic economy. And that's where I think there's been a policy mistake over many, many decades in the UK that needs correcting.
And it's going to take time.
Probably decades to reverse in the opposite direction. Albeit...
And we need a stable government as well, don't we? I mean, I think a lot of the problem, which gets back to risk and everything, is it's very hard for anybody to want to take risks. For our client-based financial advisors, wealth managers, advising your underlying clients on investments is very hard, because we touched on IHT or many of the other investments they make. You don't quite know what the repercussions are going to be in a year's time. You might have to unwind all this, and it turns out to be not what you were planning.
Yes, undoubtedly a secure political backdrop, which is why Rachel Reeves' narrative of securonomics is starting to sort of cut through. But maybe I should retract the answer I gave, that say decades to unwind. I think we live in such a pro-cyclical capital market that if you see signs that what has been an underloved asset class starts to see flows back into it, both public and private capital markets, actually momentum can do an awful lot of this job for you.
And a lot faster than it used to, because everything's moving so much faster.
100%. Yeah. And therefore, if you look at the Bank of America Merrill Lynch Fund Manager Survey, UK equity, UK assets, the pound has been an underweight asset for many, many years, certainly since the Brexit vote, so coming up to 8 years now. Therefore, if you reverse that, you've got a lot of people reversing short positions, and anybody who's played around in capital markets know that people covering short positions can lead to some very big price action very, very quickly. But you do need the catalyst for that. And this would be my point, is that public policy can let the private sector do the rest of it, or private investors do the rest of it, if they set the conditions for reallocating back to the UK. And I'll leave perhaps on this topic with reflections I had from when I went to the US at the end of Q1 and speak to US investors about owning UK equity. And they said, we love UK assets. They screen cheap. There's some great companies. You know the problem we have? You don't want to buy your equity. So why should we be buying your equity? And some of them are still, regardless of that. But they're like, you don't have faith. Your domestic saver base, your domestic pension fund don't have faith in your own market. Why should we? But that also tells me is when they see signs that the domestic market move, they'll crowd in. Very savvy investor base, a lot of capital to deploy, love the UK investment story, but need to see signs that the domestic investor is moving first.
So it's good to get the kind of positive there, because I think there was a lot of negative that we've been focusing on. But I think one of the things as well, particularly with advisors and their investors, is they're very risk averse naturally, and we talked about risk very early on in this. Uncertainty doesn't help at all. We've had a prolonged period of uncertainty with various things. We've got the elections, etc., coming up. But can you relate this to previous we've been similar stages of the business cycle, and how the recovery's happened? We talked about it can happen very quickly. They just said first we said decades, but then you said it can happen very quickly.
Yes.
But are there any specific points in history we can relate to that will help people understand where we are right now?
So you'll probably need older viewers to remember the
That's
period
right, you got Mel and I.
Yeah.
For yourself.
The late 1980s is probably the closest parallel I can find when you look at valuations where the UK was at material discount to the rest of the world. And actually, 1987 through 1989, the UK equity market was a very, very significant discount on price earnings, price book, EV, EBITDA. And then it unwound pretty quickly. And actually, for the decade that followed that, there was really strong outperformance of UK equities versus the global benchmark. And so there are precedents. But the problem is you have to go back, more than 3 decades to get there, and the number of people still active in markets who were active back then are fairly thin on the ground. But
it's made me laugh because it makes me remember the old city image of the guy with the massive mobile phone.
Trigger TV where he goes, hello!
Yeah, no, I was thinking when they were all there, I can't remember what they were called, but anyway, yes. It gives me back to those vibes when the city was really sort of buoyant.
Obviously there was Big Bang in the mid-80s, and then there was enthusiasm, but then there was, the back end of the 80s was a difficult period, quite a deep recession in the UK. But coming out of that, a number of political events that have echoes actually right now, the ERM crisis, the UK leaving the exchange rate mechanism, but also an oil shock that then dissipated again, an energy shock. There are parallels there that investors and fund managers and wealth managers who are looking for, if you like, historical reference points. I think there are some things that are definitely chiming from that period.
And one thing I thought, maybe just sort of wrapping us up, is portfolio selections for a lot of our advisors, wealth managers, in terms of sort of client portfolios. Do you have a view on what you would put more in alternatives? Or do you feel that there is a growing need to have this diversification get much bigger exposure because the UK marketplace is changing so much?
I think my sense on particularly alternative funds, if you're looking at that, is that there is a huge, huge capital investment program that needs to be funded to electrify the economy, to make up for 30, 40 years worth of infrastructure underinvestment, nearshoring, friendshoring of supply chains. That's going to require capital. And therefore, I think funds that are part of that solution, because I can tell you something, and this is from 10 years in the civil service, it's not going to be put on the public sector balance sheet.
No.
Because the public sector balance sheet, while it has been more stretched, and it was post the First and Second World Wars, in post-war history, it hasn't been as stretched as it is now. And we're starting to see strains in gilt markets, most obviously around the mini budget in 2022. So I think the public sector's appetite to do that. So there's going to be some form of either private deployment of capital or public-private partnership. And I think alternative funds that can tap into that, the infrastructure, the energy, the tech ecosystem that is going to need to be rebuilt, that's where you would imagine some pretty supernormal returns are going to be available over the next few decades. And it's a multi-decade, that definitely is a multi-decade capital spend pipeline.
Yeah. Any more on that?
Yeah, I guess one point I was going to make was, again, going back to our client base and the advisors, so quite often for them, the first experience they have of investing in private markets is through the tax wrappers, which, as Mel mentioned earlier, we've got the EIS, VCT, IHT. Yep. Mm-hmm. And because they're not seeing the exits, because they're not necessarily seeing the returns that historically they've seen, it's almost become the problem with the wrapper itself. It's an EIS problem or a VCT problem. So less so on the VCT because they've had the dividend yield, so they're quite happy with that, although they may see the NAVs depreciating, but they at least have had something back.
And there is liquidity, they can sell into the buybacks.
Yeah. Yep. Whereas with the EIS particularly, it's been much, much harder, and we've seen investments go down in particularly the last couple of years into EIS. I guess what would be good to hear is it's not really the wrapper problem, is it? It's just where we are in that business cycle, and exactly what we've been discussing here and there. It's just private equity, the cycle, low M&A, low IPO activity.
Mm-hmm. Well, economic factors do not play out as quickly as the prices on people's screen. Doesn't matter whether you're a trader or an investment or a wealth manager, your Bloomberg or your Refinitiv terminal, changes like that. But actually real businesses making decisions about deployment of capital on exits, they see interest rates change, energy prices change, consumer patterns change on what consumers have, how they behave, how they commute, how they work, what they demand, services versus goods. There's been so much flux over recent years. The idea that businesses looking for exit can present to their next investor a stable track record, operating in a 5% interest rate environment, operating in a working from home environment, operating in a trade war, post-COVID, supply chain friction environment, post-Brexit environment. There's so much flux that actually the capital markets activity takes a while to adjust because you need the next investor to have confidence and stability. And to some extent, what I would say is the product is absolutely the right part of the funding ecosystem, both for growing companies but also delivering returns to investors. But what you are seeking, it comes back to Melissa's point, is you do need a period of stability, either political or economic stability, for those things to start to crystallize. Because that's the way the real economy works, even if the things on your screen happen in almost real time.
Yeah.
And I mean, there is signs, isn't there, that hopefully the marketplace is turning a bit. I think H1 2024 is showing a lot stronger signs in IPOs, in M&A. So, I mean, hopefully...
I think that's right. I mean, there's a number of IPOs on the road at the moment, which is always good to see. A number of private raises as well, where, as we mentioned about 20 minutes ago, the owners have come back with more realistic pricing because they've recognised a different cost of capital environment. I think it's really important that the first... if you like, marquee IPO that gets away in the UK does well because...
We'll get the snowball effect.
You do. And you look at some of the IPOs that, Deliveroo is pointed as one, Cap Payments maybe as one. There have been a number that in recent years, Aston Martin is perhaps the poster child for all of them, that have destroyed shareholder value. And therefore the appetite to fund these goes away. But if you start to see one, and I think the one that people are putting a lot of hope on is Raspberry Pi, if that gets away and aftermarket stability, decent returns, the founder owner doesn't try to take too much money, it feels like it's something that's done quite well, then confidence extends its way across the market, and then you see something of a snowball effect. That's why it's really important the first one out of the traps goes well.
Well, I think, shall we look to wrap up on a positive?
I think we should on a positive note, yes.
Brilliant. Well, thank you so much, Simon, for coming and joining us. And hopefully we might get you back on to the Alternative Thinking podcast. Thank you.
Thanks, Bill. Thanks, Simon.
Thanks.
To hear more from Steve and I, tune in to either YouTube on video, or we're also available on all good podcast channels.